Hello, everyone, and welcome to this, our Wednesday, the 11th of March show. We have James Garis, who's going to walk us through CPI. We have CPI live. Let's get over to the show, ladies and gentlemen. It's my pleasure to be trading live if there's any opportunities, and we'll walk you step by step through what the CPI data is telling us today. Very pivotal day, potentially a big market moving day. So let's get our seatbelts strapped and let's get over to the show. Without any further ado, we're going to bring on James Garis. James, how are you doing today on this CPI day?
I'm doing well, thank you. We're fully into spring. The sun's out. The moods are good. The markets are busy, so can't complain. But yeah, we obviously have CPI ahead. You can all see my screen that I've shared. I'm going to kind of run through a bit of a CPI preview. Some of that will obviously touch on a little bit of the US-Iran tensions, because obviously the big thing off the back of that is the surge in energy prices, and that affects obviously inflation, which affects interest rates, and that's what this all kind of stems back to. And we do have a very, very busy couple of weeks coming up in terms of a bit of a central bank bonanza, which I'll speak about in a second as well. But as for CPI, we're about 11 minutes away. In 10 minutes time, I'll turn the stream squawk up full volume so you can hear the news as soon as it comes out, hear the headlines. But with CPI, analysts had said that the February CPI data may not inform the course for the US monetary policy. Now, just a quick kind of what that means. When you get economic data like NFP or CPI and you see that quick reaction in the markets that is kind of untradeable, that is essentially traders repricing their interest rate expectations. That's all that is. And it's what kind of markets really, in a way, kind of move around, or a big factor of it. But analysts have already said that this bit of data may not kind of change that interest rate expectation, since it's largely a reflection of prices before the Middle East conflict. Obviously, we're getting this data in March for February, and the US-Iran tensions, I think, started on the first kind of weekend of the month. I think it was like the kind of end of February, the first kind of few days of March is when it first kicked off. But before the conflict, officials were already warning that the prices remained above the central bank's target, which is obviously 2% for inflation, and inflation was above that. And that barring any kind of sharp downside in the labour market, which we have seen, obviously we had NFP on Friday last week. They expected to add 58,000 jobs to the economy. We had minus 92,000. It was the second largest month of job losses since the pandemic. And I put an interesting article in the group chat yesterday as well about how the jobs numbers over the last year or so have been horrific. And maybe that's something we'll spin back to, as well as the central bank stuff after the kind of CPI preview and the data. But policymakers have previously suggested they can look through one-off price jumps. So if we get a kind of one-off kind of surge in inflation, they can potentially look past that as they think it will come back down. And obviously we're having that kind of one-off surge in energy prices off the back of these geopolitical tensions in the Middle East. But whether that sustains or not, you know, for oil to go from $50-60 a barrel to 120, done that very quickly. Then it kind of jumps back down to 80. Okay, but getting it back down to 50, 60, which is a kind of range they're comfortable with, it's a lot harder for it to kind of get back down there and sustain there. And we know that Trump has wanted lower gas prices, as he calls it, you know, gas at the pump. He wants it to be $2 a gallon, I think they call it over in America. But traders may look through the policy implications of the February CPI report as they seek further clarity. I think next month and even the months after CPI will be really important, because it will start to price in the effects of the war. However, analysts expect the events with inflation already above target. It could make it difficult for the Fed to sound dovish at its March meeting, which is next week, next Wednesday. But all in all, headline CPI is expected to rise 0.2% month on month in February. The annual rate is seen unchanged at 2.4% year on year, and the core CPI is also seen rising 0.2% month on month. The annual rate is seen unchanged at 2.5% year on year. So the year on year figures and headlines are expected unchanged, but we're expecting small rises in the month on month for both the headline and the core. But knowing the distribution of forecasts is really important. Obviously, we have, like I've just mentioned, we've got these numbers here. That's 2.4%, obviously year on year. How they get these numbers is you get a big survey from economists and bankers, and they all kind of put in what their predictions for CPI is. I give a little example of this a little bit lower. We've got the Goldman Sachs preview, and they obviously explain in there all of the different components of inflation, kind of how they get their estimate on what inflation will be. So you survey all of these economists, and they obviously give their answer, and then the majority is what the expected data is. So you can see that the CPI year on year, the majority of people voted 2.4%. That's why it's the expected data. So knowing the majority is obviously important. That's what's expected. But knowing what I call the second majority, which falls under this distribution of forecasts, is really important because it shows you where the kind of other consensus is, what other people in the market think. So for year on year, we can see that 54% of people think it will be 2.4%, but actually 39% of people think it will be higher. So that would kind of obviously make you think, okay, if the data is not going to come in bang on line, it may be a little bit higher than what's expected. On the month on month, it's the opposite. We've got 61% think 0.3, but actually 39% think it could be lower than what's expected. On the core year on year, we've got the 69% consensus for 2.5. Above that, we've got 12% that think it could be higher, 19% that think it could be lower. And for the core month on month, we've got 54% that think it could be 0.2, but 46% of people think it could be higher. So it's a little bit mixed, really. We've got higher for year on year headline, lower for month on month headline. We've got lower for the core year on year, and then higher for the core month on month. So it's very mixed, but given the focus on the war, the market will likely shrug off a soft report and a report that's lower than what's expected, since the data is already seen as old news. It's before the war started. But on the other hand, a hotter than expected report, a report that comes in higher than what's expected, could trigger some risk aversion, as investors might worry that inflation was already picking up before the war began. And we know that from the start of this war, obviously higher oil prices could make it even worse going forward. So if we see a softer report, I don't think it would probably move the market as much. If we see a report that's higher than what's expected, I think traders are going to start to panic a little bit, because you're going to probably see next month's data jump up in the expectations as well, because obviously they'll start to price in these higher energy prices. And I think obviously that makes it very tricky for the Fed going forward. We've got the Fed meeting next week. But for them, if inflation is higher than what's expected and showing signs of rising, they will obviously go, well, we're going to have to hold interest rates where they are, or potentially start to raise them again. Bearing in mind, they've been on a kind of cycle where they've been cutting rates and trying to bring rates down. Obviously, higher inflation equals potentially higher interest rates. Higher interest rates means that the bond yields go up, which indicates obviously higher rates. You'll get a stronger dollar, potentially weaker gold, although high inflation is kind of good for gold in the long term. That initial market movement, the dollar would be strong, and you probably wouldn't get that. And obviously higher inflation, higher interest rates is a double whammy for the stock market, and it's bad for stocks as well. So in terms of the event trades, a strengthening scenario, obviously you can see here, would be the inflation rates being higher than what's expected. And in this scenario, the dollar would strengthen as markets reduce their expectations for an interest rate cut. A weakening scenario, on the other hand, you'd expect US dollar weakness as markets increase their expectations for a rate cut. But given the uncertainty, traders may place less emphasis on the immediate policy implications of this report, while awaiting clearer signals, obviously from future inflation reports that will take in, obviously, the surge in energy prices. So it's a bit of an interesting CPI, maybe not kind of the most important one, because you imagine some traders will be more focused on next month and the kind of couple of months that will follow. But nonetheless, it could be interesting, because if it's higher, people are going, oh, inflation's already coming up quicker than what was expected before the war. That's without the surge in energy prices and oil prices. So I think on the hawkish side, you'd see a really strong dollar, and it makes Powell's job, Mr. Chairman of the Fed, Powell, it makes his job very difficult next Wednesday in trying to maintain a dovish tone, because he can't, you know, and I think obviously a lot of people have wanted Powell to cut rates. And I think they'll be kind of leaning more towards the other way. So it will be kind of very interesting next week, next Wednesday. Most likely going to do a big live stream for that as well. Obviously an hour earlier, because the clocks have gone forward in America, but not in England yet.
It's a bit wild. It's a weird time. Like, even for like the final hour of trading yesterday, it ended up being earlier than I expected. So it's just throwing everything all over the place. But yeah, we have about a minute and a half left before I think you've basically hit all the high points. I think the main thing is this CPI report is not going to cover the war, but you did say there is a risk here. If inflation is coming in hot or higher than expected, then there could be a major reaction. If inflation's higher before the war, we can't imagine what it's going to be like after the war. And then, like you said, also the meeting next Wednesday is very timely for the Fed interest rate.
We've got less than a minute. The last point I would make on that as well is, before NFP on last Friday, we had comments from Fed's Waller saying that he expected the PCE data that's coming out this week, I believe on Friday, I'd have to double check the calendar, but he believed the PCE data was going to come in hotter than what was expected anyway. We know PCE is the Fed's preferred inflation metric. They prefer this to kind of CPI, but CPI still is the headlines because it's consumer price index. We're obviously consumers, everyday people that get affected by inflation. But I think the Fed already think that some of the inflation metrics could come in higher than what's expected. And obviously, this brings up the stagflation question. You've got high inflation, but shocking jobs numbers. High inflation, you have to raise interest rates. Bad job numbers, you lower interest rates. The Fed get fucked, basically. Apologize for my language, but we're a few seconds out. The analyst stream is on full volume, as you can see here. And we should be getting the data very soon.
Here we go. Are you seeing anything or hearing anything?
In line. All in line.
Okay. All in line. Okay. Yeah, I'm seeing it as well. Muted reaction so far. Not seeing a big reaction.
So all in line, which is probably okay for this market reaction. Obviously, we'll get a muted market reaction off the back of that. I think the only thing that you maybe see a little bit of a stronger dollar off the back of that is still the fact that the month-on-month data, which I'm just going to kind of show here, you can see month-on-month headline inflation, month-on-month core. The previous data was 0.3, 0.2. Obviously, we've got a little bit of an increase on the month on month. So still in line with what the expectations were. It didn't beat the expectations, but we're still seeing a little bit of a rise in the inflation data. But obviously muted market reaction off the back of that, as all the data's bang in line, and it definitely makes the Fed's job a little bit easier on Wednesday, but still not an easy one for Powell. But yeah, muted market reaction. You don't obviously get that often where all of the data's in line is very rare. Normally it's kind of all one way or the other, or sometimes you get a little bit of a mix either on the year on years and the month on months, or the headline and the core. But all in line. I can't remember the last time I saw data that was kind of all in line. It's a bit of
a little
rarity these days.
anticlimactic a little bit, and I think it looks like prices aren't reacting much after that.
I wouldn't expect kind of too much market reaction off that. I think initially we've seen a little bit of a kind of stronger dollar off the back of that, and that might just be down to the little bit of an increase from last month, but obviously nothing too bad in the sense of it wasn't higher than what was expected. It was within their expectations and within their market pricing, so it makes it a little bit I guess a little bit boring for the day traders that maybe would have liked a miss or a beat on the data, but makes it a little bit easier for the big boys and the investors who it's obviously in line with their expectations. But just first reaction, obviously seeing a little bit of a stronger dollar off the back of that. You can see kind of cable and euro dollar coming down a little bit, and dollar yen rallying a little bit. Dollar yen kind of quietly amongst all of this war news has crept back up to that kind of 159 level, where we obviously saw a bit of a rate check from a couple of months ago or so. We obviously saw a bit of a rate check in dollar yen, and we're quietly creeping back up to that level, and it's kind of gone under the radar a little bit amongst all the war news. But that could be something interesting to watch out for over the next kind of couple of weeks with central bank decisions as well. But obviously muted market reaction off the back of that. So not kind of, as we said, ideal for the day traders, but is what it is. I can't remember, like I said, the last time we saw kind of such a quiet or inline bit of data like that,
Yeah, I agree. Usually we'll get some surprises, and I think we were kind of set up for a little bit of a surprise based off of Friday's miss on non-farm payrolls. And that kind of gave me the indication that, okay, maybe the analysts and the economists' estimates are not as close as they used to be. But today they seem to be spot on with those prices. I am seeing yields are increasing. So I'm looking at the 10-year yield. I'm not a big bond trader, but it looks like yields moved higher on the 10s, 20s, and 30s. And just worth mentioning that later on today, 5 p.m. London, 1 p.m. In New York, there's going to be a 10-year Treasury bond auction. So maybe that has in the past caused some ripple effects through the market. So maybe we see a potential surprise move later on in the day during that 10-year auction.
Definitely worth definitely worth noting and keeping an eye on. But just initial reaction, obviously yields up, indicate interest rates going a little bit higher, dollar up off the back of that. Obviously, pound dollar, euro dollar lower, dollar yen up 0.3% on the day now, and seeing a little bit of a decline in the futures. Obviously Nasdaq, S&P, and the Dow all about 0.3% down on the day so far. But I think still the kind of outstanding performer on the day really is oil. It's only up 1% on the day, which is quiet for oil at the moment. I think the other day I looked, it was up 13%, but across the board kind of oil still obviously a little bit bid. But on the jobs numbers, I don't know if you want to just pull my screen back up, Mandela.
Here we go. There you go.
Can. On the jobs numbers, there was this that I posted yesterday, and for those that obviously follow the NFP data every month, you would have seen over the last 12 to 18 months, we've had big revisions downwards. So obviously every month we get our kind of data, and then the next month they bring the data again. But they also say, actually last month we got it a little bit wrong. We was out by 4,000 or 20,000 or whatever it may be. And going back to August last year, we got a big revision from the BLS, the Bureau of Labor Statistics in America, and they had said that actually the jobs numbers over the last year, we'd got it wrong, and we'd said that over 1 million jobs had been created, but actually the 1 million jobs hadn't been created. So it basically wiped 1 million jobs off the NFP data, and that was kind of August last year. But I posted this yesterday just saying that US jobs numbers have now been revised down in each of the last 13 months. So in the last 13 months, they've gone back on the previous month's data and said, actually, last month we got that data wrong. It wasn't as many as we thought, and that has kind of added up to being a total of minus 710,000 jobs, which means employment was initially overstated by an average of 55,000 jobs per month. So every time you get your NFP data, they've actually kind of worked it out, and they've got it wrong by saying there's an extra 55,000 jobs every month. The US job numbers were revised down by another minus 4,000 jobs in January and minus 65,000 in December. So it brings the December reading down to minus 17,000. So again, December was actually a month where jobs weren't created, they were lost, and marks the fifth contraction over the last 9 months. Out of the last 9 months, there's been 5 months where there's been negative numbers once the revisions have come around. So it kind of sneaks a little bit under the radar, because you have NFP and they go, yeah, we beat and we created 60,000 jobs. And it's like, well, actually, over the last, as it said, 30 months, the average is, you've initially overstated by 55,000 jobs a month, you know, so it's a little bit kind of skewed data. And since January 2024, there have been downward revisions in 24 out of the 25 months, which is shocking. And I know there's a bit of a situation in the UK at the moment with the ONS, the Office of National Statistics, who release all of the UK data, and they've been kind of criticised that a lot of their data has been wrong. But America need to be kind of looked into as well, because the jobs data and the way they work it out is awful. And then when you look into the actual jobs data, when they say, 50,000 jobs have been created, and you kind of go, what were them jobs? Who got them jobs? A lot of the time it's Native American citizens, like Americans, losing jobs, and illegal immigrants coming into the country obviously are taking them jobs. And then within that as well, you look at kind of who's taking them jobs on, or what kind of jobs they are. Full-time jobs are dropping and part-time jobs are rallying. And it's been like this over the last 3-4 years. I have got the charts kind of somewhere on it, but it basically means that any jobs that are being created, it's not like the economy's strong and people, especially say Americans in this case, getting full-time employment. It's like the economy's actually shit, and we're not having a full-time job anymore because we're working 2 or 3 part-time jobs. So the part-time jobs numbers is massive because they can't have just the one job. You know, the average American might be, you know, working in the day and then working at a waitressing at a bar or a restaurant at night or whatever. They're taking on multiple part-time jobs to deal with the economy. So the jobs numbers I think it's a dark cloud that is looming over the economy, and that's without throwing in the kind of AI doom and gloom of people losing their jobs as well. And we have seen massive layoffs because of that recently. So I just kind of wanted to point that on the NFP data as well. Like, the NFP data is bad, but it's actually a lot worse than it seems, but it just kind of doesn't steal the headlines. And I think, I don't know why that is. I think just because, I mean, we recently discussed the Mag 7 Mandela and the kind of
I remember that.
And although 6 out of the 7 of them companies are stalling at the moment, the hope is just on them 7 companies to like perform well and everything will be okay. But I think the jobs is something that could quietly kind of creep up on the US this year.
Yeah, I think that's definitely a dark horse, and it, like you said, it's not getting a lot of press. Even the miss on Friday, when you gave us that really good preparation and commentary of the non-farm payrolls on Friday, it didn't get as much press as I thought it would have gotten. And then, like you said, I think the revisions tend to be swept underneath the rug. People don't look at the revisions as much as the headline numbers as they are announced. So
definitely,
I think this is something we should continue to track as well.
In the middle of all these tensions and obviously surging oil prices and missiles and everything like that, these kind of things get lost a little bit. Like I kind of mentioned with the dollar yen as well. You know, it was only a month, maybe 6 weeks ago, if that, the dollar yen was back up at 159, and they were doing a rate check and potentially on the verge of intervening. And then, we obviously had a bit of a sell-off in dollar yen. It slowly climbed its way back up to 159. And it's like nobody's mentioning that 4-6 weeks ago, they were thinking of intervening at these levels, and it will definitely still be on the cards. It's just not kind of stealing the headlines because obviously the war news is.
Yeah, everything is about Iran and the war. Everybody's an expert, and I'm still trying to keep up with the announcements. I know Trump on Monday said something like the war is going to end soon or it's virtually over, and then yesterday they're talking about Pete Hegseth said it was the most missiles, the most attacks they've done thus far. Then they're talking about the mines. Dropping mines in the Strait of Hormuz, whether or not that is substantiated or not. I think it's very fast moving, but I do like your analysis and your summaries. It kind of cuts through a lot of the noise and provides a very clear sort of picture of what's going on.
Yeah, I mean, the headlines have been very conflicting. We had Trump kind of Sunday night, like Monday, basically saying the war will be over soon, and we obviously had the drop in oil prices, and then we should be getting some news maybe within the next half an hour or so. We've got a meeting at 1 p.m. with the IEA, and we've got the G7 as well, obviously speaking about releasing oil reserves, which would temporarily help, but it's like putting a band-aid on a burst pipe type thing, really. But it would temporarily help kind of push down the prices of oil and obviously provide people with oil. But we've just had conflicting kind of headlines every day. Obviously, Trump said the war will be ending soon. Then we had Israel say, well, we're not ending it soon. We still want to attack. Obviously, the other day, Iran were saying that, basically an apology. We're sorry, we're not going to attack any of the Middle Eastern neighbors unless an attack comes from their territory, which on the way they kind of worded it, it's like, it sounds okay. It's okay if Saudi don't attack us, we won't attack them. But the US have bases in Saudi Arabia and are attacking from that territory. So it's like, if US attack from any of them territories, we'll still attack you. And obviously, things seemed a little bit like they were pushing towards de-escalation talks a little bit yesterday kind of morning, like Monday evening, Tuesday morning. Seemed like we was getting little hints of de-escalation talks, not so much kind of towards ceasefire, but just things seemed to calm down a little bit when you was looking at what was being said from Trump and the White House and from Iran. And then obviously you get another headline comes out yesterday, and it's like, well, Iran are thinking about putting mines in the Strait of Hormuz. And it was, again, this was a bit of a weird one, because the first initial headline said there was US intel that Iran were putting mines there. Then Trump come out and said, we've had no reports of it. And it's like, well, your country that you're president of just said they had this intel. And then there was another report that come out a little bit later on in the evening. I think it was more kind of late last night, that said they had taken 16 mines out of the Strait of Hormuz. So it was like, it's very conflicting headlines, and obviously you can see that in the price of oil, because oil was like a yo-yo. It's up, down, and over the last kind of 48 hours or so, it's been very volatile, obviously, of these headlines. So you have to be kind of aware of the headlines, and that they're much more powerful than probably the technicals at the moment. But it's hard to obviously navigate when the headlines are conflicting like that. You kind of just have to really, in a way, trust the market, in the sense of the market is where the money is, and the market kind of knows best in the sense of if oil is coming down and there is maybe escalation type talks, but if oil still kind of drops, it's like traders don't really believe them escalation talks. And on the vice versa, if oil's rallying but they're saying, oh, the war's going to end soon, but it's still rallying, it's like, well, traders don't really believe the de-escalation talks, so I think you kind of have to trust the market in this sense, because the market's always going to move to what people really believe, as opposed to what world leaders might say to make people happy, if that makes sense.
Yeah, no, I completely agree. And it was interesting because on the Monday, if you look at a chart of oil on the Monday, I can probably pull it up. It was basically doing exactly that. So the price of oil was almost like it knew that Trump was going to Trump was going to announce the whole de-escalation and ending soon. This is a five-day chart. So this would have been the start of play on Monday, and then all day it was pulling back, and then we got that announcement out of Trump in the last hour of trading, where he said it's going to be de-escalated. But oil had already kind of shown you that there was something that was favorable, or something that was bearish oil, I guess.
I think the trigger for that, though, was on Sunday evening, probably very early hours Monday. We got a bit of a kind of rumor and like hint from the G7 that they were going to release strategic oil reserves. So I think if that kind of first sharp move down Sunday night, like early Monday on oil, that was the when the headline come out about G7, and obviously that kind of played into the sentiment throughout the day, and then you kind of get that second kind of sharper move down that you can see on your screen. Later Monday was obviously when Trump come out and said with kind of de-escalation talks that the war will be over soon, you know, but we will have to see. I mean, personally, the way things were going, and I put a bit of a kind of message out about this as well, and it was basically saying that everything that Trump hates is happening, in the sense of he hates high oil prices, and we were getting high oil prices. He hates yields like being high, and bonds being low. He wants a strong bond and a low yield, and he wants to cut interest rates. And obviously all of this kind of news in the sense of oil surging, inflation going back up, which he doesn't want, would lead to interest rates going back up, which he doesn't want. He wants interest rates low so he can refinance a lot of the government debt. The stock market was dropping, and you know, Trump will come out and say, well, the Dow's going to new highs and stuff. He loves a strong stock market. So everything that Trump hates was happening in terms of the markets off the back of this war. And although Trump will have certain probably agendas that he's got to fulfill through the war, I guess one of them being, for example, taking out the supreme leader of Iran. Maybe another you could say is coming to some sort of nuclear deal and agreement. I think another interesting thing about this is the Strait of Hormuz and the insurance kind of game, because obviously they can no longer like insure the oil tankers are going through, and all the insurance is done through Lloyd's of London and through the City of London. They've kind of controlled Iran and Iran oil a little bit financially for like the last 120 years. That's how BP, British Petroleum, kind of come about, because they went into Iran and took control of their oil. But they kind of said that we can no longer insure the Strait of Hormuz, and kind of Trump come out and said, well, we'll insure it then. And it's potentially a very, very smart kind of play that, again, isn't stealing the headlines, because it's kind of taking a 120-year-old business off the British and bringing it back to America. But obviously he'll have some agendas that he's probably got to fulfill, but he's also a market man and a businessman, Trump, and we know that he kind of keeps a tight eye on the markets. And seeing oil up at, you know, $100 or $90 a barrel, the stock market dropping, interest rates potentially having to go up, inflation potentially going up, he won't like them things. So I think for me, before the week started, I was kind of speaking to people and I was saying, I think we could get a ceasefire potentially by next weekend. And then the de-escalation talks on Monday, I was like, oh, maybe I'm going to be right. And then Tuesday they go, oh, we're putting mines in the Strait of Hormuz. And you're like, you know, like, you know, it kind of escalates a little bit again. So maybe I was wrong. Maybe it's not kind of over yet. But you definitely have to just play it kind of day by day with this stuff and can't make too many assumptions. Long term, I guess it becomes a little bit of a kind of day traders market in a way, as opposed to a swing traders, maybe in that sense, depending on how you're positioned.
Yeah, I noticed that completely, that, you know, you have to be very, very precise and almost like surgical. And you're in, you're out. I feel like it's very difficult to get into a position and hold it for a few days, up to a few weeks, because you don't know what the next headline or what the next move is really going to be. So definitely favoring the more nimble traders amongst us. But did you hear about the there was a announcement that a U.S. Navy ship had helped to shepherd a oil tanker through, and then that tweet was deleted, and then they came out and said that hasn't happened yet. It just seems like it's all over the place.
Yeah, and this is the problem as well. And it's not even like you can't even put that down to like getting news from wrong people, whatever. Like all credible companies, Financial Times or Wall Street Journal or whoever are reporting this. It's kind of the Mr. War. You obviously get fake headlines sometimes. So I did see that, and then we got some news earlier on today about 5 a.m. that the U.S. Navy has refused near daily requests from the shipping industry for military escorts through the Strait of Hormuz. This was reported by Reuters, and the details included that the US Navy says the risk of attacks is too high for now. The US Navy has held regular briefings with shipping and oil industry counterparts. During those briefings, the US Navy has said it's unable to provide escorts for the time being, but sources say that as of Tuesday's briefing, the risk assessment has not changed. So the Strait of Hormuz remains largely closed, but then I have also seen some reports and some data that a lot of these oil tankers, maybe not a lot, but quite a few oil tankers are actually kind of turning off their GPS and their transponders, navigating through the Strait of Hormuz and then turning it back on again to, I guess, not be kind of, if you've got your GPS on and you're going through the Strait of Hormuz, you could probably easily be targeted by Iran. But if you've got no GPS on, they probably couldn't. It's not like they're standing on the riverbank, the edge of the river, and kind of dropping a missile on you. You know, they're properly coordinated attacks. So I have seen reports and data that some obviously ships are passing through, but again, it's conflicting because Trump will go, we'll ensure people to go through the Strait of Hormuz and we'll provide your safety. We won't shut the Strait of Hormuz. And then the US Navy refused to escort people through there. So it's like, what one is it, you know? And again, it's very kind of conflicting headlines.
Yeah, I remember this as well. You highlighted this because remember we had that lead up into the war, and so Trump was basically trying to play both sides by saying he wanted to come to a solution. They wanted to come to get some sort of deal. They were actually doing the peace talks or the negotiations. And then on the flip side, he was saying, well, we're asking everybody to leave the region. We're clearing out. We're sending ships that way. So it was very much conflicting. And it almost seems like there's a lot of communications going on, wires getting crossed. And it's just, I guess, a reminder of how messy wars can be. And I think today is going to be an interesting day. We do have a few comments here, James. There's a message here from Mark Juari saying, great insights, James. That's on the CTI YouTube channel. We also have Mir Sabir saying hello and Brian Walsh saying hello. Interesting day in gold today, also mentioned in our comments. And we have Brian Walsh as well, who's watching us during this stream today. Actually, I do have to say a special thank you to you, James, for suggesting that we jump on today, because this is a very topical subject, and I think it could also be a very pivotal time in markets going into that Fed meeting next week. So thank you for suggesting that we jump on here today.
Thanks for the comments, everyone. I guess a couple of different points on that. Firstly, the dollar still kind of rallying quite a bit off that CPI data. So definitely seen a bit of a stronger dollar off the back of that. Secondly, obviously someone said about gold. I think a lot of people have maybe been confused about gold's movement since the start of the war. Obviously we go war, safe haven gold. But the problem is with this, obviously gold had that kind of initial move up, and I think we got to just getting my chart back up. We had an initial move up in gold, which was on the Friday, the 27th of Feb, then the Monday, the 2nd of March, and we got back up to about 5,400 on gold. But then on the Tuesday, the 3rd of March, we had a big sell-off, and gold's not really like moved anywhere much since. I think people were confused, like, why is gold not going up? But to put it as simply as possible, the war has caused a surge in energy prices and oil prices and gas prices. Them energy and oil prices going up means inflation will most likely go up. And we've kind of spoken previously like just earlier on this call about how it might not be reflected in today's data because today's data was from February, which was before the war started. But the upcoming months of inflation data could be really, really important for markets and for the Fed. But obviously, you get a surge in oil prices. This could push inflation up. If it pushes inflation up, the central banks, which I'm going to touch on in a second as well, because we've got loads of central bank meetings coming up, and you just mentioned the Fed. But if inflation's going up, the central banks will have to keep interest rates where they are or push interest rates and raise interest rates a little bit higher. And obviously you see the bonds come down, the yields go up, but interest rates going higher is good for the dollar. So we've seen a strong dollar since the start of the war. Since kind of the end of February, start of March, we've seen the dollar rally, and this is because the dollar's looking and going, well, if inflation's going up, it's good for the dollar because interest rates will have to go up, which is good for the dollar. You get more global foreign investors pull money out of the stock market or out of gold or other assets, out of Bitcoin, and just keep it in cash, keep it in dollars because they're getting a little bit of a better interest. So we've seen the dollar up off the back of the war, and this has temporarily kind of suppressed the gold prices, and we haven't seen that kind of massive breakout and rally in gold. And I think some people have maybe been confused a little bit about that, but you have to kind of strip back to basics. Like, what does this mean? Well, oil prices are up, inflation's going to go up, interest rates might have to go up, the dollar goes up, and obviously temporarily, like in the short term, that pushes gold down, you know. So I think that is kind of why we've seen kind of gold go lower. But you obviously just mentioned the Fed as well, and I think that's kind of the last point I'd touch on really, is that the next couple of weeks are going to be massive. We have a bit of a central bank bonanza, as I'd call it, and obviously as inflation fears come back into the picture, major central banks have a challenge ahead of them in the coming weeks and months, and there'll be plenty of eyes watching, scrutinizing them over the next couple of weeks. We've got the Reserve Bank of Australia on the 17th of March, the Bank of Canada on the 18th of March, the Fed on the 18th of March, the Bank of Japan on the 19th of March, the Swiss National Bank on the 19th of March, the Bank of England on the 19th of March, and the European Central Bank on the 19th of March. So next week is going to be a massive week for central banks. The only one missing out of that is the Reserve Bank of New Zealand, who will only return with their rate decision on the 8th of April. So it's going to be a really, really busy 3 days. Like normally, the central bank meetings, they're normally kind of pushed across a couple of weeks. I can't remember the last time I saw a week where you've got Australia, Canada, America, Japan, Switzerland, England, and the European Central Bank all doing their interest rate decision within 3 days. It's crazy, really. But there might not be too much drama in terms of rate decisions. I don't think anyone's going to maybe make any decisions apart from potentially the Reserve Bank of Australia. But we are starting to see market pricing reflect that sentiment. The odds of rate hikes next week, they were at 35% before he spoke. This is for Australia, but they've jumped up to 71% now after he said they might have to take kind of action. This is again for the RBA, and obviously we've seen a kind of Aussie dollar surge on that. We've seen a strong Aussie off the back of that, but the US-Iran conflict is obviously threatening stronger price pressures on inflation, and this is pushing a lot of central banks and a lot of investment banks to shift their calls on interest rate expectations. So I think next week we're not really going to get too much in terms of decisions, apart from potentially Australia, which is, we've seen decent strength in the Aussie recently, and it's kind of been a good play as market expectations for a rate hike were very low, and now they've jumped up massively. So we've seen the Aussie dollar become really strong off the back of that. But I don't think we'll get any other decisions across the board. But the main thing will be watching, obviously, their forward guidance and in the press conference and in Powell's press conference. What are they going to say? Will they revert back to what we saw in 2021, 2022? Kind of dismissing inflation and calling it transitory, which we know it wasn't in the end. Inflation went up and stayed up for quite a while, which was obviously a big mistake. So it'll be interesting to see kind of what they say. But considering all of that, we're 2 weeks obviously into this conflict. most central banks will probably try to be a little bit flexible and kind of reaffirm a bit of a wait and see approach and not jump to any conclusions on how price developments and inflation is going to change. But they will definitely have to acknowledge the risks of higher oil prices and inflation to come, but they definitely won't kind of commit to anything so early on. Obviously to save their own arse, if you like, but market participants are expecting interest rates to remain high or potentially go higher for this year. And obviously it's the market players and participants like us, not necessarily us, but the big boys, the investment banks, obviously move these markets. So understanding the difference between kind of what the central bank thinks, but what the market thinks, that difference is kind of where there's normally good opportunities in the markets, especially in obviously Forex in this case.
Yeah, no, absolutely. And thank you for setting that out for us. We did get a few comments here. One's from Vincent Lightbourne. Thank you very much for joining us today. And thanks also for anyone who's watching the replay later on today on CPI Day. Happy CPI Day for everyone who's celebrating. Freddie Moose, I hope I'm saying that right, says, where can I find an official channel for the G7 statement release? This is the one about them releasing some oil reserves.
Yeah, I think we had, as you can see here, we had the IEA reportedly to announce recommendations on strategic oil reserves at 1 p.m. today. Had nothing through the wires or the headlines yet, otherwise it would have just come through the speaker. But we're expecting a potential kind of, or they're going to announce their recommendation on releasing oil from their strategic reserves. Was for 1 p.m. Maybe they're in that meeting now. We've not kind of got the headlines yet, but could expect them very soon. So I'd recommend obviously looking at your news terminal or looking at Twitter or X as it's called now for kind of any obviously headlines off the back of that. But we've also got the G7 meeting that's lined up this afternoon as well. So I think by the end of play today, we probably will get an announcement about them releasing oil reserves, but I guess you just have to be mindful of kind of the like how much will these oil reserves really actually supply, like how many barrels are they going to draw down from the reserves in the first few weeks, how quickly can these barrels make its way to transport and be shipped to where it needs to go, who's in the mix, like what's the crude quality like, because for those that don't know, you get different kind of quality of oil. The US, for example, produce a pretty low quality. I know Venezuela as well. Venezuela is very, very difficult to refine. Yeah. In terms of the refining quality, like the US is a kind of very low quality. The Middle East is kind of in that middle section. Venezuela and Russia, for example, theirs is thick and harder to refine. You know, so it's kind of what's the crude quality going to be if you're getting all of these kind of countries and not world leaders but participants from like the world and the G7 and the IEA releasing oil reserves. What type of oil is it? You know, we need to know what we're getting. Who's going to handle the logistics? Who's going to make sure the barrels reach the refineries and stuff like that? But I think all of them questions, if you're in the oil game, they're important. But as the headlines will take it, the market probably won't care as much. As long as they hear something like 300 or 400 million barrels are going to be released, they'll probably go lovely. Like the people in the oil will care what type of oil is it, how long is it going to take, who's doing the logistics and all of that stuff. The people that are actually kind of trading and will focus just on that first headline, G7 released 350 million barrels of oil, they'll go lovely, and you'll probably see the market move off the back of it, you know. So I think just focusing on the headline with that will be the most important thing. As soon as I get any news from it, I'll pop it in the group as well, but I've had nothing come through so far, just checking the wires, but nothing come through so far. So I'd expect they're kind of in the meeting and between the IEA and the G7 over the next half hour or hopefully in the next few hours we'll get something from them. Let's keep an eye out on that. And Freddie's come back and said thank you very much. James, I'm going to get ready to get locked in on the Open.
Remember, the open is 1 hour early, everyone. Anybody who's affected by that. Just a quick shout out and thanks to everybody. So Mark Juwani, thank you for your questions and comments. Mir Sabir also in the office today, and Brian Walsh. We should do these more often, I think. It would be nice to do a couple more of these, especially coming up to the Fed announcement. James,
definitely, we'll get some locked in for next week around the rate decisions and stuff. But as always, thank you for having me on here, mate. Very much enjoy coming on. It's a pleasure as always, and hopefully anyone listening has found it insightful and useful and helps to make a bit of money on the market. So I guess the last thing on that, there was something funny in the group chat yesterday. I'd kind of put out a report and someone had taken a trade, and I think it was pound CAD, and he'd come into profit and posted his profit in the group, and I just replied and said, "Well done, mate." And he said, "Thanks, like your insights have been a great help." And I said, "Okay, well, I'll send my invoice for a 10% profit split then. Just let me know where to send it." And he was laughing. But yeah, I hope everyone's enjoyed it. And anytime, Mandela, thank you for having me on here, mate. It's a pleasure to speak markets with you.
Always a pleasure, James. Have a great day today, and we'll speak to you all next time. Thanks, everybody. Take care.
Good luck, everyone. Thank you, Mandela.
Cheers.